Now let's look at the three methods for computing the GDP. These three methods include expenditure approach, income approach, and product approach. So now let's begin with the expenditure approach. In here we say that the expenditure approach need to add up the total expenditure on the domestically produced final goods and services. Once we are able to add up all the expenditures on the domestically produced final goods and services, then we will be able to come up with a GDP number. When we want to come up with the GDP from this approach, the key question I would like you guys to ask is who is the final users? Once we will be able to identify the final users, we just simply add up the expenditure of those final users, and then we will be able to come up with GDP. So then who is the final user? We are the final users, the consumers, because for all the good that is produced, at the end it goes to the household. We either use it or consume it. Therefore, we are the final users. So then why identifying the final user is important when we want to come up with the GDP from the expenditure approach? If you recall our previous example about the cheesecake, for the cheesecake that is produced by the factory, it is worth of $10. And for the cheesecake that we buy from the bakery, it is worth $15. And for the cheesecake that we made by ourselves, we bought it from the market with the cost of $7. So then under that particular case, once we know we are the final users, then when we want to come up with the GDP for that particular case, we know that if we buy the cheesecake from the factory, the total expenditure on the cheesecake that is made is $10. So the GDP will be 10. If we buy the cheesecake from the bakery, and given that the total amount we spend is $15, and given that we are the final users, so we know under that particular case, the GDP equals 15. For the last case, given that we buy all the ingredients from the market and we are the final users and the total amount we spend is $7, so the GDP equals $7. So then you will be able to tell that from that particular case, the GDP will be different for different cases. But what we want to do to come up with the GDP for an economy is that we just identify who is the final user, and then we count how much is spent by the final user, we add it up, and then we are going to get the GDP from the expenditure approach. Later on, I'm going to give you an example, but right now I want to move on to talk about the concept for the three methods first. So then the next approach is called income approach. The income approach just simply add up the total income earned by the domestically located factor of production. So when we want to come up with the GDP using the income approach, we need to ask how much is earned by all the factor of production. Once we know how much is earned by all the factor of production, we add it up, then that will be the GDP. In here, that we need to first know what is the factor of production, and we need to know the income of each type of the factor of production. We know the factor of production can be labor, can be capital, can be land, can be entrepreneurs. And then the payment to the labor will be wages, the payment for the capital will be the interests, the payment to the landlord will be the rent, and the payment to the entrepreneur will be the profit. Therefore, when we want to come up with the GDP from the income approach, we need to add up the wages and the interest payment and the rent payment and also the profit. And the profit is the trickiest part because a lot of time in the question it will tell us how much we pay for the labor, how much we pay for the capital, and then it will imply how much is the profit. It could be zero profit, it could be positive profit, we don't know. So when you want to come up with the GDP from the income approach, you need to take care of the profit part carefully. You need to ask yourself whether or not there is profit. If there is any profit for the production process, we need to add that in when we want to come up with GDP using the income approach. Finally, for the product approach, we need to add up all the value added by every firm. So the key questions we need to ask to come up with GDP using the product approach is that we need to ask what is the value of the goods that is produced for each firm, and then we ask, is there any intermediate goods? If there is any intermediate goods, then the value added of that particular firm will be the total value of the good they produce minus the value of the intermediate goods. If there is no intermediate goods, the question will become simple because the total value of the good that is produced by that particular firm will equal to the value added of that firm. So at the end, we know that when we come up with the GDP from the expenditure approach, income approach, and the product approach, they need to have the same answer. If the answers are different, it means that there is something wrong with your computation. That is because we already know earlier that the total expenditure needs to be equal to total production, and the total value of the production received by the firms need to distribute it to all the factors of production in form of wages, interest, and profit, among others. Therefore, when you come up with GDP from these three methods, they need to have the same number. Now let me show you two examples about how to come up with GDP using these three methods. In the first example, we have three agents in the economy. We have miller, we have baker, and we have households. And for the household, I abbreviate it as HH. The miller provides flour to the baker and the household, and the baker produces bread and sells it to the household. The household provides capital and labor to both the baker and the miller. So then the household buys $20 flour from the miller and $140 bread from the baker. The baker also buys $60 flour from the miller, and the miller pays $50 for hiring labor and $30 for renting the capital, and the baker pays $60 for hiring the labor and $20 for renting the capital. So now we want to show how to come up with the GDP from three approaches by looking at this example. So first, we want to come up with the GDP using the expenditure approach. When we want to come up with GDP using the expenditure approach, we need to ask that who is the final user. Once we identify who is the final user, we just simply add up the spending of the final user, and then we are going to get the GDP. So under this case, the household is the final user, and the household spent $20 to buy flour and $140 to buy bread. Therefore, to come up with the GDP, we say that it is 20 plus 140, and it will equal 160. So now we want to use the second approach, which is the income approach, to come up with the GDP for this economy. So when we want to come up with the GDP using the income approach, we need to identify all the payments to all the factors of production. The factors of production can be labor, capital, If they use land, then land will be the factor of production. If they use entrepreneurship, that's probably hidden somewhere, then we need to add the profit into the total income. So under this case, we know the household provide labor not only to meter but also to the baker. The total income they receive from providing labor or the wages, and it's the $50 that they receive from the meter and the $60 they receive from the baker, which end up to be 110. How about the income they receive from providing the capital? They provide the capital not only to the meter and also to the baker. And so the interest that they receive from providing capital will be 30 plus 20, which is $30 that the meter pay for capital and the $20 the baker pay for the capital, which add up to be the $50. So how about profit? We know that if the total received of a firm is greater than the total payment the firms paid, then it implies that the firms in fact have some profits left, and then that will be the payment for the entrepreneurship, and that also need to be counted as part of the total income of the nation. Therefore, we need to look at whether or not the meter has profit. So let's look at the total amount the meter received. It turned out to be that equals 80 because it sells $20 flour to the household and $60 flour to the baker, so it add up to be 80. So how about the total payment that the meter made? The meter pays the $50 for labor and $30 for capital, so the total payment the meter made is $80. Therefore, the meter has zero profit. How about the baker? For the baker, the total amount they receive is the total value of the goods that they produce, which is the bread, which is $140. Then how much is paid by the baker? The baker, in fact, pays the $60 for the labor and $20 for capital. In addition to that, you need to remember that the baker uses the intermediate goods. And in here, when we are coming up the GDP using the income approach, we do not think about the intermediate goods, but we think about the payment that the baker made. The payment the baker made is $60 for buying the flour. Therefore, it's need to be part of the total payment the bakers made. Therefore, in here, the total payment the baker made is 60 plus 20 plus 60, which is the payment for labor, for capital, and then also for the flour. And then it add up to be 140. So under this case, the baker also has zero profit. So then now we want to come up with the GDP using the income approach by adding up all the payment to all the factor of production for this economy. It all turned out to be that we adding the wages, which is the payment for labor. We adding the interest, which is the payment for capital. And if there's any profits for the two agents, then we need to add that in. It turned out that the meter pays $50 for labor, and then the baker pays $60 for the labor, so it add up to be 110. For interest, that is the payment for capital, the meter pays the $30 for capital, and then the baker pays $20 for capital. Therefore, it add up to be $50. Finally, for this case, the meter and baker both make zero profit. Therefore, we add up 10. So the total GDP equals 160 in this case. And the answer is exactly the same as what we got from the expenditure approach. Next, we want to come up with the GDP using the product approach. When we want to come up with the GDP from the product approach, we need to know the total value of the goods that is produced by each producer, and then we need to think about whether or not there is intermediate goods. If there is any intermediate goods, we need to take that value out and only counting the value added. So now we want to first look at the value added of the meter. It turned out that for the meter, it produces flour and it sells $20 flour to the household and $60 flour to the baker. So the total value added of meter will be $20 plus the $60, which equals $80. In our example, we assume that the meter do not use any intermediate goods. How about the value added of the baker? We know that the baker produces bread and the total value of the bread equals $140. But the baker uses flour as the intermediate goods. Therefore, we need to take the value of the intermediate goods out when we compute the value added of the baker. And then so the value added of the baker will be $140 minus the $60, which equals $80. So then what will be the total GDP of this economy? It will be the value added of the meter plus the value added of the baker, which equals 160. So in here, I just want to remind you that if we compute the GDP using the total market value, what will be the number and why we prefer to use the value added instead of the total market value of the goods that is produced. It turned out that if we look at the total market value for the meter's total market value, is quite clear. It is $80 because it produces flour and it sells the $20 flour to the household and $60 flour to the baker, so it adds up to be $80. For the baker, the total market value is the value of the bread that it produced, and it turned out to be $140. And in fact, this $140 includes the value added of the baker, which is the $80 plus the value of the flour, which is $60. So we know that if we count the total market value of the baker, it has the value added of the baker and the flour that the baker bought. So then if we add it up, then we are going to have 220. And here we clearly see that we are counting the flour the baker purchases twice when we are counting the value of the good that is produced in this economy. Therefore, when we want to come up with the GDP using the product approach, we need to use the value added instead of the total market value. Otherwise, there will be double counting. So this completes the computation of GDP using the three approach, looking at the first example. Now, let's look at the second example. The second example is very similar to the first one, except that the payment to the labor for baker now changed from 60 to 40. We want to see how will that affect the way we compute the GDP. So now let's look at how to compute the GDP using the expenditure approach. From the previous example, we said that given that the household is the final user, so we just basically add up the spending of the household and then we are going to get the GDP. And in here, it remains as 20 plus 140 equals 160. How about how to come up with the GDP from the income approach? Given that in the new example, the baker pays $40 for labor instead of $60, let's look at how will that affect the income for different factor of production. So for labor, now we know, given that the labor pays 40 instead of 60, so we cross out the 60 in here and we got 40. So now the total payment for labor equals 90. How about the payment for capital? It turned out to be exactly the same because it didn't get changed at all. How about for profit? We know that the total amount the meter received remained as 80. The total payment the meter made remained as 80, so it still have zero profit. However, for baker, even though it still received $140 for selling the bread, but now the total payment somehow got different because the wage payment now reduced from 60 to 40. Therefore, the total payment now equals 120. So then it no longer has zero profit, but it has positive profit because the total payment is less than the total received by 20. So the profit equals 20 in here. So then because of that, to come up with GDP, we add up all the payments to all the factors of production. In this economy, the factor of production includes labor, capital, and entrepreneurship. Therefore, we add up the wages, the interest, and the profit for this economy. And it turned out that the wage payment now equals 50 plus 40 instead of 50 plus 60. The total payment to capital remained the same, but now we have profit, which equals 20 instead of 0. So then the total GDP remained adding up as 160. So now let's look at how to come up with GDP for the second example based on the product approach, given that the baker's payment for labor does not affect the value added of baker. Therefore, all the computations remain the same for the product approach under the second example versus the first example. So this completes our discussion related to how to compute GDP using the three methods.